ASTS SpaceMobile is one of the most innovative companies on the planet right now. Well, can we even say they're on the planet? Some of their businesses outside of the planet in space as they're launching satellites to help improve communication technology. And if you're interested in this stock, I've done some digging here and I found some things that you need to know about this company before you make your decision on buying or selling the stock. So I'm going to share with you some information and some insights that you can utilize to make your decision about this company.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So one of the things I found to be important is how this company is being impacted by tariffs. The management team said that their average capital cost, including direct materials, launch costs for their constellation over the 90 Block 2 Bluebird satellites, will fall in the range of $21 to $23 million per satellite. So they plan to have about 90 of these Block 2 Bluebird satellites, and each one will cost them roughly $22 million per satellite. But this is higher than their previous estimate of roughly $20 million each satellite. So the costs have increased by roughly 10%. And it's primarily driven by higher launch costs from their announced near-term schedule, as well as higher direct materials cost due to the recently announced tariffs. So the tariffs are having an impact on ASTS SpaceMobile. To build the components to build these satellites, they need a lot of components, and they're importing some of those components, and their costs of goods will increase, and thereby increasing the overall cost by roughly 10% from 20 million to 22 million at the midpoint. Not a huge increase, but a meaningful increase. The company, as we'll discuss in a little bit, the management team said still, even with the higher cost, they're still their estimates to become profitable at a certain number of satellite launches remains intact. And here's that comment from the management team. We reiterate our belief that the operation of about 25 of these satellites will enable us to potentially generate cash flows from operating activities. So in other words, being either break even or positive in cash flow from operations, which is a critical inflection point, because from that point onward, they will be significantly less reliant on investors to raise capital. They won't need to raise capital by all that much. So they expect to increase their capex in Q2 to a range they believe will be around 250 million, primarily reflecting the timing of payments on multiple launch contracts. So let me recap a little bit what we've discussed so far. At 25 satellites, they plan to be cash flow positive, but also they're going to build around 90 of these satellites. So, in other words, roughly 1/4 of the way through, they plan to be profitable in cash flow. And then at full scale, when they have those all 90 of them launched, they can potentially generate significantly more in cash flow from operations. So at 25, that will be the break-even point or the inflection point where they turn positive in cash flow from operations. And then between 25 and 90, that will be additive to their cash flow from operations. And my estimates is that it will be additive exponentially from that point onward. So if you want to follow along, this document I'm looking at here is the company's most recent Q1 2025 conference call transcript. I have this specific document, my highlighted document, available for channel members. If you want to join, you can access this and follow along as I'm going through these videos. The management team said they expect revenue to ramp towards the end of this year and into 2026. More specifically, they believe they have a revenue opportunity in 2025 between $50 and $75 million, and it'll be heavily back-end loaded. So most of this will come in Q3 and Q4, not so much in Q2. So the upcoming quarter, the one we're in right now as I'm making this video, is Q2. the management team believes in Q3 and Q4 that the revenue will ramp up significantly. Of course, the company will report financial results for the second quarter, and they'll give us even more insights into what the back half of the year looks like. And that's going to be a very important earnings call with the management team and Wall Street analysts, one that I will be covering to be sure. So if you're considering this company, you want to know about the balance sheet. You want to know how much money they have, because this company is going to need money to build up and launch and go to market with this technology before they start reaping the benefits of their investments. So they ended the first quarter with $875 million in cash. That was up by almost $300 million, a little more than $300 million from the previous quarter. The significant increase was primarily driven by roughly $400 million they received from a convertible note offering in late January. So those of you that don't know what a convertible note is, it's a financial instrument for investors that can be either a bond-like offering or a loan-like offering, right? Where the company says, we will pay you your $400 million back in 5 years. And between now and the time we pay you back, we'll give you 4% interest or 8% interest, right? So it has that component embedded in the note. Additionally, you have a conversion embedded into the note, meaning that if the stock price goes up a certain amount, the investors that own that bond or note can convert the bond into a stock. So you go from being a lender to the company to being a shareholder of the company at your discretion. So the investor has the choice, and the investor will only exercise that choice in the positive circumstance. So if ASTS SpaceMobile is very successful over these next few years, part of that success will be diluted because that convertible note, those investors that hold the convertible note, will convert their note into stock. And so that will increase the share count and decrease the earnings per share because there will be more shares outstanding. So it's like having a bond with an option to turn it into a stock. Okay, so that's what a convertible note is. And a lot of early stage companies use this financial instrument because it allows them to borrow money at a lower interest rate. So if they were just giving out a straight loan, they would have to pay maybe 10-15% interest on that loan. But if they embed an option for a conversion into shares, they can get that capital at a lower interest rate. So it's a mix between selling more shares of your stock and borrowing money. It's kind of like an in-between instrument. And the option is held by the investor. And since the investor is getting the option, the investor is willing to accept the lower interest rate on the bond portion, on the loan portion, because they also have the chance to make a huge return if the share price increases substantially. Okay, so these are the things at the very least I think ASTS SpaceMobile stock investors should know about before buying or selling the stock. I have a few more videos on this company. If you're interested, I suggest you watch those also before making a purchase decision. This is one of those high risk, high return types of investments that could 10x your money in a short amount of time, but you can also lose a significant amount of money if these launches and satellite don't work as planned. So this shouldn't be for those risk-averse investors. This should only be for investors that have a higher risk tolerance. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.